All right, let's get right into it. Welcome to This Explainer. Today, we are taking a deep dive into the absolutely crucial provisions of Section 263 under the brand new Income Tax Act 2025. Look, if you're a chartered accountant, a tax professional, or running a business, getting a firm grip on this new framework isn't just helpful, it's absolutely essential for your day-to-day practice.
So, let's kick things off with a highly practical situation, one that is probably on every professional's mind right now. How exactly do our filing obligations shift during this massive transition? Just imagine it's July 2026. What forms are you actually filing? Which financial year are you assessing? And maybe most importantly, which act are you even complying with?
Okay, here's our quick roadmap for today. We'll start with a basic introduction to Section 263, break down exactly how the provision works, look at a real-world taxation example, cover your compliance and due dates, tackle those tricky transition issues, and then wrap it all up with some key takeaways.
Let's jump straight into Section 1, an introduction to Section 263, which is basically your new baseline for filing returns.
Now, we are witnessing a monumental paradigm shift here. We are completely moving away from that old previous year and assessment year model and transitioning into a streamlined, single tax year concept. For over 6 decades under the old 1961 Act, we had to juggle 2 different financial years referring to the exact same income, right? The year you earned it and the year you were assessed for it. Well, the Income Tax Act 2025 completely scraps that confusion. The tax year now serves both purposes. So the income you earn in financial year 2026-27 is simply filed and assessed as tax year 2026-27. It's a real game changer.
And right at the heart of this new tax year concept is Section 263. You can basically say goodbye to the old Section 139. Section 263 is now the central foundational framework for who must file a return, when they've got to file it, and the types of returns, whether it's original, belated, revised, or updated.
Moving into Section 2, let's break down the provision and see exactly who falls under the radar of Section 263.
Okay, so the crucial takeaway here is that corporate entities and firms, they must file universally. It literally doesn't matter if you're making millions in profit or running at a massive loss, you are filing. But for individuals and HUFs, you generally only need to file if your total income exceeds the basic exemption limit. Oh, and a quick reminder, if an assessee wants to carry forward any business or capital losses to future years, filing a return under this section becomes strictly mandatory. But wait, we have some very specific exceptions to talk about. So here is where it gets really interesting. Under Section 263, read alongside Rule 280 of the Income Tax Rules 2026, there are high-value triggers. This means even if an individual's income is way below the taxable limit, triggering any of these specific transactions makes filing absolutely mandatory. If you deposit over 1 crore rupees in a current account, spend more than 2 lakh rupees on foreign travel, or incur over 1 lakh rupees on your electricity bills, yep, you are legally required to file. No exceptions.
Let's make this perfectly clear by moving to Section 3. We'll walk through a highly practical real-life taxation example.
Picture this. You've got an individual running a small, unregistered manufacturing setup. For the given tax year, their actual taxable income, 0, thanks to various deductions. But their electricity bill for running all that heavy machinery came out to 1.5 lakh rupees during that same tax year. Now, even though Step 2 clearly shows 0 taxable income, Step 3 instantly flags that electricity expenditure under Rule 280. Because of that, they absolutely must follow through the Step 4 and file their return under Section 263 to stay compliant. All right, smoothly moving along to Section 4, let's examine the critical compliance points, documentation, and the strict filing due dates you simply cannot afford to miss. Some good news here. The core deadlines remain functionally consistent with what you're already used to. For general individuals, it's still the 31st of July following the tax year. For corporates and cases requiring a tax audit, you're looking at the 31st of October. And for transfer pricing cases, it's the 30th of November. The dates themselves haven't really changed, but you've got to remember, the section number enforcing them is now Section 263, subsection 1. However, for late filings or corrections, pay really close attention here. The timeline is strictly capped from the end of the relevant tax year. You get exactly 9 months to file a belated return under Section 263.4. You have 12 months to file a revised return under Section 263.5, and for an updated return, which is basically the equivalent of the old ITRU, you've got up to 48 months from the end of the financial year succeeding the relevant tax year, and that falls under Section 263.6.
Now, for the professionals out there handling audits, this is huge. Form 26 entirely replaces the old forms 3CA, 3CB, and 3CD. This brand new comprehensive audit report falls under Section 63 of the 2025 Act, and it comes with a hard deadline. It has to be filed exactly 1 month prior to your main return due date. So if your return is due on October 31st, that Form 26 better be filed by September 30th.
And finally, under Section 265, you need to ensure your documentation is fully compliant by having the proper authorized individual actually sign and verify the return. This largely mirrors the old Section 140 from the 1961 Act, detailing exactly who can sign for an individual, a company, a firm, or an incapacitated person.
Okay, Section 5. Let's tackle the transition and the most common practical issues that are bound to pop up during the rollout.
I am hearing a lot of panic about the overlap between the old and new regimes. But relax, there is absolutely no missing year or double filing required here. The transition handles this beautifully through Section 536, which is the Repeal and Savings Clause. Tax law doesn't just abruptly stop and start. The old and new laws coexist to make sure everything shifts seamlessly.
Just make sure you don't confuse the two regimes. It's literally a line in the sand. Income earned up to March 31, 2026 still uses the old 1961 Act. You'll file that as assessment year 2026-27 using the old ITR forms on the portal, but the very second you earn income from April 1, 2026 onwards, that utilizes the new 2025 Act and the new tax year 2026-27 terminology using brand new forms.
As tax professionals, we have to proactively avoid these common mistakes. The biggest trap, quoting repealed section numbers. If you try to file a tax year 2026-27 return citing the old Section 139 or process a TDS payment citing Section 194C instead of the new Section 393, you are going to face immediate system-level validation errors on the portal. It will literally reject it. So update your software and update your mental models right now.
All right, we made it to Section 6. Let's summarize everything into a few key, actionable takeaways. To quickly recap, master this new tax year concept, which finally aligns the earning and assessment periods. Map out your firm's compliance calendar specifically to the new Section 263 due dates. Keep a super sharp eye on those Rule 280 high-value triggers, like that 1 lakh rupee electricity bill. And finally, lean on the transition provisions to calmly navigate the bridge between the old and new acts. As we embrace this incredibly streamlined, modern legal code, I want to leave you with this thought. How prepared is your practice, your software, and your entire team to seamlessly navigate this historic shift without a single compliance hiccup? The time to prepare is absolutely right now. Thank you for watching. Please like, subscribe, and share. This video is for educational purposes only and does not constitute professional advice. Tax laws are subject to amendments. Please consult your professional advisor before taking any action. This is an AI-generated educational video.